we love short-term rentals. We're doing a bunch of those right now. It's been a tougher product historically in the institutional space, and I think the real operators in the space, you guys, know how to execute, know how to get these done, and worst case scenario, if you had to get out of that, you'd find a way to get out of that. Interest rates are determined based off of risk in a loan. So higher LTV typically is going to come with a higher rate. Higher FICO score, lower rate. Higher DSCR will come with a lower rate. So like the positives that you have as a borrower and for that transaction will lead to a lower rate. The institutional side is a little bit different, right? Our loans that we do, we fund and ultimately sell to institutional loan buyers. So big distinction between what it is we do and Rehab Wallet is, we do non-Dutch interest. We want to get people involved because we know that we'll make a little bit of dough from this place on the cash flow perspective. We're going to make way more money by the deals that you get into as a result of being a part of this.
I love that, dude.
Share deals, invest in deals, share resources. That type of stuff is that's you want to share within this group.
Welcome to The Big Break Show, your go-to podcast for real estate investing, business acquisition, mindset, and lifestyle. Now, let's dive into Season 2 with your hosts, Rafa Loza and Dan Tollins.
What's up, everybody? Welcome to another episode of The Big Break Show. And as you see, we are still at the Helm, recording in person, in studio. And I'm super pumped, as always, with my man, Dan Tollins.
That's right, brother.
How's life today?
Another beautiful day.
Always. So we got a good show for you guys today.
Yeah.
Right? We got Whit McCarthy here with us, and he's actually one of the founders of the Helm. So thanks for coming on, man. I appreciate it.
Yeah, appreciate you guys having me. I've followed you guys both individually for a long time, so happy to participate.
Appreciate it, dude. So you want to, before we get started here, you want to let everybody know who you are, what you're about, background story, and then why you're on the podcast.
Cool. So I grew up in Connecticut, went to school up in Maine. Right after I graduated from school, I said, enough of the cold, drove out to California, ended up in Los Angeles, the Manhattan Beach, Hermosa Beach area. Was out there for about 11 years. Bounced around different kind of industries, and then ultimately landed in the real estate world, which is always the ultimate plan. 2014 was just fortunate enough to be in the right place at the right time and land inside of a group called, at the time it was Civic Home Loans, just a conventional mortgage shop. And we were trying to build that up from scratch as just a mortgage broker. We very quickly realized the conventional lending world is a bear, not fun at all. So transition out of that, we were able to sell that. And I was not a principal of that company, but we sold that to another lending institution, lending group, and we started the hard money lending business, which was Civic Financial Services, which over the course of 9 some odd years, we built that business up and originated just over $10 billion worth of business purpose loans, primarily fix and flip, bridge, a little bit of small balance multifamily. But that's where I really have learned the entire world of real estate. And again, right place, right time. It just kind of blew up, and very fortunate to have some incredible leaders and mentors helping drive that ship that got us to where we were.
I was just telling you, I don't know if I told you this last time we chatted, but I use Civic Financial for a property in Milwaukee that I did, and it was great. So, okay, it seems like lately a trending topic has been lending.
Yeah.
Right. Quite a bit of people are talking about lending and the money side of things in real estate, which is kind of funny because, like, for me, I've never been able to wrap my head around it. I'm good at numbers, but just like unless I have it on a spreadsheet, it's like, dude, like the points, the interest. I want to touch on that a little bit now since we have you here. You're kind of an expert at this. Can you kind of dumb down how lending works, what interest rates look like, how points work, all that stuff, so that our listeners and viewers, if they want to, and we're going to dive deep into your background a little bit, but I want to kind of get it started this way. Talk about all the entire, like if someone were to go and say, hey, I want to use a hard money loan, and they have no idea what the hell a hard money loan is. Right? Like, let's talk about that for a second.
Yeah, I mean, I think it's a really key difference between hard money and business purpose, right? Business purpose lending is more of an institutional environment in which loans are originated and ultimately sold. Hard money lending is typically done out of a fund structure or done with individual note type sales. So, just an important distinction between those two. Like, for instance, I moved here to Charleston 3 years ago now, and was so grateful to walk into this incredible investor community. And it's like nothing I've ever seen before. So welcoming, and everyone kind of took me in and helped me get to know everyone in the market. And so I was with Civic for another year and a half or so. And then we transitioned, and I transitioned out of that business and started up Consistent Capital in partnership with Kelly Garrett and the Rehab Wallet team. So Kelly's a partner of mine in Consistent Capital, and it kind of shows you side by side our two businesses are very different in the way that they operate.
Yeah, I was going to ask. So we sat down with Kelly and kind of went over, what Rehab Wallet is and how they kind of operate. And then we were really excited to hear kind of the difference between Rehab Wallet and Consistent Capital and kind of the back end, I guess, of that.
Yeah. So Rehab Wallet, they're incredible at what they do, right? Because they have entire and complete control of the process, the way that they do everything in their day-to-day, because they're an unlevered debt fund, right? They raise money from accredited investors, put it into a big pool of money, and ultimately deploy that capital with their own terms, their own underwriting, all the above. And so they can do things really quickly, avoid pretty much all red tape in the process, minimal documentation. As long as they're comfortable with that person and property, they're good to go.
Yeah.
The institutional side is a little bit different, right? The business purpose side, which is where I've been my entire career. And that entire business revolves around originating ultimately to the secondary market, right? Our loans that we do, we fund and ultimately sell to institutional loan buyers. So big distinction between the two businesses. We have more documentation that goes into it. We're very good at what we do as far as process and timelines, but it is a different process. With more documentation, you get better rates, right? Oftentimes you get better terms. A big distinction between what it is we do and Rehab Wallet is, we do non-Dutch interest on all loans that we offer, whether it be ground up construction, fix and flip bridge, which just means you're only paying interest on the drawn funds. That's really hard to do out of a debt fund structure because you have investors that you need to be paying that return. And if you're not deploying the entire balance of that note to someone, it's hard, right? I mean, people that are working in our world need
it's dead money.
Yeah, exactly right.
Yeah.
So back to your original question though, like explain kind of what goes into the origination of a loan, right?
Correct.
Hard money or business purpose, whatever it
Any
is.
type of loan. I think the idea here is trying to get people to understand that there's different ways to get loans and there's different loans for different products.
Absolutely.
And different things that you can work with, right?
Yep.
Like I just found out no more than a year ago, you can get lending on businesses. And I was like, wow, okay, why didn't I ever think of that? So like, there's a lot of stuff out there that even some of us that are like really good at what we do don't know about these things.
Yeah.
So if you can just touch on those products a little bit.
Yeah. So the main products that we focus on are DSCR, right? Debt service coverage ratio loans. That's a big part of our business and why we originally linked up with Rehab Wallet. They needed a diversification of their product set, right? They are so good at what they do with 6 to 9 month bridge loans for fix and flip opportunities. But they have so many borrowers that want to hold on to those properties for rental purposes and need a secondary financing outlet to be able to put that into a long-term rental. So
they need to get out of Rehab Wallet and then get in with Consistent Capital.
So we've got that BRRRR process built out internally, right? They come in, do the quick fix and flip with the Rehab Wallet money, and then get into our loan on the backside if they want to hold on to it. So
and how do they start that process with you? Like how far into the process with the fix and flip, right? So like, is it towards the latter? So if it's a 9-month loan, right, they start working with you the last few months, so they're teed up. So when that loan, matures, they're ready to.
Exactly right. We want to be able to, strike before the maturity hits. We don't want our, the borrowers to get caught in any, extension type situation if we can avoid it. So ultimately, it comes down to the appraisal, really. So we want to make sure that when we get the appraisal completed, the property's done. Right. Yeah. We don't need the property to be leased up necessarily. So we can close on a vacant property and just utilize market rent for the determination of the DSCR loan. But you definitely need that property finished and complete because these are stabilized loans on the DSCR side.
So like when we finish the historic house in Wilmington, right, we've got that loan with Gary in place and then we'll be ready to transition with the DSCR loan with you. I think it's appraised at 1.2 or 1.3 and we'll have $850 in debt on it. So
short-term rental? Yeah, we love short-term rentals. We're doing a bunch of those right now. It's been a tougher product historically in the institutional space because a lot of the big loan buyers and institutional counterparties in the secondary market, the Wall Street players, they're just not huge believers in the Airbnb, VRBO, short-term rental market. And I think there's reason to be concerned in some areas, right, with legislative changes in areas. Like things can change on a dime and all of a sudden you've got a loan with a monthly payment of $6,500, but the monthly rent on that thing on an annual basis is $3,200. It's like, well, what the hell are you supposed to do now? So I get why, but there's some people that are wisening up to it and understanding that the real operators in the space, you guys, right, know how to execute, know how to get these done. And you're only operating in markets where you know that there's surety in your ability to execute. And worst case scenario, if you had to get out of that, you'd find a way to get out of that. So, on the DSCR side, we love the short-term rentals. We're typically sizing up to 80% of the market rent of the short-term rental. So we'll get a 1007, which is an appraisal addendum completed that will do an assessment of the short-term rental income, and we'll utilize 80% of that. You have to factor in some sort of an expense ratio into those deals. And so as long as it qualifies on the cash flow at 80% of that, we'll be able to close that deal.
Interesting.
Yeah.
So now, once you guys get these loans, you said you guys pass them off to an institutional buyer. Mm-hmm. What's that process look like?
Yeah, granted, I've been doing this for a year now with Consistent, right? And before this, I was part of a big group that, we were closing $3 billion of loans a year at the tail end of it. And I never had to worry about executing on the loan sales. I was the one that was running the guys on Main Street, not Wall Street, overseeing all of sales, making sure we were getting more loans in the door. So it's been a learning process to figure out what that is to sell those loans. And it's not uncomplicated. It requires a whole bunch of cash or a big warehouse line or a big bank line. So we've got a nice size warehouse line that we have from a bank that gives us 90% advance rate, which means if we have a loan for $100,000, we kick in $10K, they give us the $90K, we fund that loan. And while that loan sits on that warehouse line, we own it entirely, okay? Then we decide what's the best outlet for that. And we figure out, okay, who is the best buyer for us? And those buyers are, the Blackstones of the world. They're, big insurance companies that have a crazy low cost of capital. They're investment banks. And then there's these aggregators who put a bunch of these together and ultimately securitize into the secondary. So it's not an uncomplicated process of moving the logistics of like the paper around, right? Making sure that you are underwriting to the ultimate guidelines that end investor requires. And if something is outside of those guidelines, you probably have to place it elsewhere. So it's just figuring out who's the best outlet based off of the program, the guidelines, and figuring out how to effectively move it from the warehouse line to them to purchase. And in that process, they'll buy it at, $100,000 loan. They'll typically buy it at $103,000. So you make front end revenue and then you make back end revenue in a loan sale process.
So when someone, like, let's say I come in and I apply for a loan, you have to underwrite me with the buyer in mind to make sure that they accept that once we're done, correct?
Yeah, I mean, we know the guidelines of all of our end loan buyers. Okay. Ultimately, we have our own guidelines that we underwrite to, and we figure out based on that specific scenario who's the best buyer of that paper on the back end. So it doesn't necessarily affect you on the front end because it's our guidelines. We just figure out the best execution on the backside.
Yeah, usually you just get a new notice in the mail. Hey, here's your new
servicing transfer. So that's why I asked. I was like, wait a second. I didn't know about this until, 4 years ago or something started happening. And I started getting these loans, and I was like, why are loans being thrown around to different companies? And then I finally understood.
The servicing transfer process is a pain, man. I wish it's something that we could avoid entirely, and I hope that we get to the point of scale where we can avoid that, where we can maintain all servicing. We'll do it all in-house, because to work so hard to bring you guys in the door and offer you a good process for the origination and funding of that loan, to just get passed around in the back end, right? And then your ultimate experience with that is a pain in the ass sometimes, right? Yeah, servicing transfer is not going smooth.
Yeah, because it could be somebody completely different every single time, right? So say you did 5 or 6 loans and it gets sold to 5 or 6 different companies.
Yeah, exactly right.
As opposed to just having one servicer.
They are wisening up and they are allowing ACH transfers now. So meaning when your loan is sold, you don't have to like re-sign a new ACH. You don't have to like get all of that set up with the new servicer. So at least they're getting better with that in the industry, but it's still a pain in the ass. And it's something that I wish we could control entirely. Yeah. You just need to get big, and the compliance around managing a servicing group is just insane. So tough.
Yeah, that's how I found out about mine. It was a new login portal. That loan got thrown around 3 times. And I was like, why do I have to keep logging into different portals?
Exactly.
My bank account?
Yeah, that sucks.
I figured it out. I was like, okay, that makes sense. So why lending? Like, let's dive into you a little bit. Like, what made you? I understand you said you started with like working with the lender, but like continue doing that yourself. Like, it kind of seems like a very regulated, very complicated business.
The conventional world is wildly regulated. We're in the business purpose side, so like we only lend to investors. I've never done a loan for an individual. They've only been to investors. So as soon as you start focusing on only investors, 95% of the compliance and oversights go away.
So then let's dive into that for a second, right?
So does the emotion.
Exactly. Exactly right. Yeah.
I'm curious as to what those type of loans look like for investors. When you say investors and individual, like I understand, right? Like I go and buy my personal home, it's an individual, but if it's an investment loan, so how does that differ in terms of like qualifications? The emotion was a big part of it.
Yeah.
So like, what do you see, and how does that differ in terms of those two different types of buyers?
Yeah. So, I mean, a conventional loan, you're qualifying based off your DTI, right? You've got to have your income at a certain level, right? And all of your total expenses, it needs to be balanced out at a certain number.
Taxes and all that.
Exactly. Yeah. So on the business purpose side, we only lend to LLCs or corporations. Like we lend to businesses with, investor who actually knows what they're doing, with a game plan, a strategy, and an exit strategy if it's a short duration loan. So you get around a lot of the bullshit you have to deal with in a conventional loan because we don't ask for any tax returns. DTI, the acronym, debt to income ratio. In our group, it's don't talk about income. I don't want your tax returns. I don't want any of them. So, in a DSCR loan, what we need to see is like your entity docs, obviously. We need to have your ID, a couple bank statements. We want to make sure you've got some liquidity, right?
Do you have to have the LLC for a minimum period of time?
No, it could be brand new, single purpose entity for that specific property.
Say you went to First Citizens, get a line of credit. They want to see you've been in business for 2 years.
Yeah, these are just essentially shelters for the property, right? And as you know, like you put your real estate, your investment properties in LLCs for protection, right? And that's the only reason we want that. Correct. And it separates, the consumer, the conventional mortgages, right, from what it is that we do, because we don't have to abide by all the compliance and regulations that exist within the conventional lending world. Like we don't even currently carry any licensing as a group. As a business purpose lender, only lending to investors, as long as you're not operating in the Western United States, where most of those states require licenses, we don't have to have licenses. So it's an unregulated business in that regard, but it's buttoned up in the way that it operates. Like we do the right things. There's certainly some that don't in this industry, right? In the lending world, as you know, like not everyone's a good guy.
Well, we try also to show face, you know. I mean, being involved in this community here. I mean, everybody that's doing something in this area in this market knows everybody, and you.
It's a small world.
You burn a bridge,
exactly right.
You get forced out of a lot of different opportunities. Or
exactly right. Yeah. So it's just we've built our business consistent capital, right? This new group on a local level. Right. I came from the world where we had most of our salespeople in California calling people all over the country. I wanted to do something a little different and wanted to focus on a hyper local level, which is the big inception for like the Helm and having a lot of this stuff put together on a local basis. So I think it's really tough when you're in a seat in California calling someone in Charleston and pitching them why they should use you when you don't know the difference between West Ashley and Mount Pleasant, right? You don't know the difference between Kiowa and North Charleston. Like it's so different. So, we really focus on having people in our group that are experts within their areas that they're overseeing. The local component is just so critically important to us.
Does that mean now that you're strictly only focused in this area, so you're not lending in other areas? Or does that mean that you're building teams in other areas so that they know the area and they're lending on the area?
Yeah, that's a good question. So we're focused in the Southeast primarily. Okay. We've got coverage in South Carolina, North Carolina. We've got coverage in Georgia, Florida. We've got coverage in Tennessee, Alabama, and up through the Midwest a little bit. Midwest is good for DSCR loans. Great cash flow states, not great appreciation states, like not great for flipping, things like that. But for rentals, cash flow is crazy. Yeah. So up through there, a little bit of the Northeast where we're getting some boots on the ground, which is important. But primarily focused in the Southeast is, I think there's just such an amazing opportunity down here. And there's been no penetration of like institutional money down here. Yeah. It's crazy.
What asset class do you guys focus on?
Yeah. Right now, we're primarily focused on residential stuff. 1 to 4 units is really the sweet spot. We've got 5 to 8 unit program as well, for both short term and long term DSCR loans. Ground up construction is a big part of our book. So a lot of residential infill projects, 1 to 4 unit construction projects. That's a real sweet spot for us in the Southeast.
Well, tell us a little bit more about that, because that's something that we're actively discussing. So that's something that obviously would service us immediately, but obviously hope for some of our listeners and viewers, might fit what they're trying to do too.
Yes, I mean, we're doing 12 to 18 month loans for builders, right? People who are doing spec builds, right? Mm-hmm. We're not doing anything if your intention is to live in that property, but spec builds or build to rent, right? We're doing a lot of build to rent right now, kind of the mid lower price point builds, cost effective,
first time home buyer.
Exactly right. So the build to rent's great, but yeah, we're typically funding up to 85% LTC, so loan to cost, back end number of 70% ARV. So we're typically, the numbers shake out usually around, if it's a purchase deal, 50 to 65% of the land plus 100% of the construction. And that money is dispersed over draws upon verification of completed work in those phases. Mm-hmm. And you're only paying interest on the drawn funds. So a lot of these deals, especially like in the Southeast, we see, initial loan amounts in like the 75 to 100K range with a, 200 to 300K budget. So you're only paying interest on that 100K up front.
Yeah.
So it's really cost effective when you do a side by side of a loan that has Dutch interest, which is full boat. You're paying on the entire amount from day one versus only paying on drawn amount. The numbers are shocking, the difference between the two of those. Mm-hmm. So, and being that we are on the institutional side, you go toe to toe with a lot of local lenders that will give maybe 100% financing, right? But they're charging on the entire amount.
Yeah.
And the leverage is great, right? Especially when you have a bunch of projects going on. But when you actually take a look at those numbers side by side, mm-hmm. the cost savings of having a loan where it's non-Dutch is wild.
So let's say you get through the process, right, of the new build, mm-hmm. and now you're on the back end of this thing. You're almost, I wouldn't say replacing Rehab Wallet on that new end, on the new build, mm-hmm. right? But it's kind of a short-term loan, hard money loan. And so now you're ready to keep it. So mm-hmm. what is the kind of the process of converting that 12 to 18 month loan to a more DSCR?
I mean, it's easy as hell. I mean, we already got the file, and I'll always tell our borrowers the first loan is always the hardest because we don't have any of your stuff, right? We don't know who you are necessarily. And so we need to get all that on file. But once we have that, especially on the construction loan, we have the original appraisal that shows us what the ARV is. Mm-hmm. We just need to get an updated appraisal, right? That's going to include an assessment of the market rent. We'll have most of the document, maybe updated bank statements, right? As long as you're not changing entities, we'll have all of that. We'll just open up title right away and get that moved into a DSCR loan in typically a couple weeks. So long as it is it appraises, right? And it meets all the numbers on the back end, then it's a very quick and easy process.
And you guys still do this for short-term rentals?
Oh yeah. That's and the rates right now, I will say, and I don't know when this is going to be released, but we're recording this, late August. So rates are so much better than they were a month ago, right? And we do anticipate that they're going to get even better, right? Into September, hopefully the Fed has something good to say. Yep. So we're hopeful, but we're finally back in the sixes on rates, right? For qualified individuals with, and I'll asterisk that, not a max LTV deal. If you want max LTV cash out, rates are going to be a little bit higher, right? So, but rates are way better than they were, which means more deals are penciling and we're getting more borrowers into loans that are good for a long-term hold perspective.
Let's talk about rates for a second.
Yeah.
Because you're right, this isn't going to be, we're late August right now, and this will probably be out in maybe late September, early October. Mm-hmm. How important is it for people to actually pay attention to where the rates are at? Because you said something important that kind of caught attention here is if you do a full loan to value cash out, rates will be more expensive. Yep. So can you dive into that just a little bit so people understand the rates and then what it means when you get higher rates in comparison to lower rates, mm-hmm. and why you would have to get a higher rate for a higher cash out? Yeah, absolutely. So one thing that I think is always good to track, right? A barometer for what's happening in the mortgage market is track the 10-year treasury. Okay. Put a little tracker on your phone, right? You can put it in your stock, tracker inside of your Apple, stock thing. And 10 years is an indicator as to what's going to happen with mortgage rates. And 5-year T-bill to an extent, but mostly the 10-year is what most mortgage rates move off of. So if you're looking at, that, you're tracking it closely and you have stuff in your portfolio, all of a sudden you see this big drop, call your lender. Right? Ideally, call us, but call your lender and see if you can get into a better loan. I mean, I think there's been a lot of loans given out in the past couple years now that are higher rate that may have some sort of prepay structure, and it may make sense to get out of that loan early if you can get to a better rate, especially if you have the ability to take some money off the table. Right? The power of the cash out refi
is the greatest thing in real estate.
Yeah.
Tax-free money is the best money in the whole world.
Yeah.
So we love assessing those opportunities for people and kind of doing that cost benefit analysis to make sure, hey, if you do have a prepay on your current loan that you have, let's figure out if there's a way we can work around that, price it in a way that will allow you to not, take a bath on it, but get into a better loan product going forward. Yeah. So the DSCR loans, most of these are written as 30-year loans. There's optionality inside of that though. So there's adjustable rate mortgage products, right? Typically 5-6 arms or 7-6 arms, which means that initial rate that you're given is good for 5 or 7 years. And then it will adjust every 6 months is the sixth part of that. It used to be 5-1 and 7-1. It's now 5-6 and 7-6 for the most part. There's 15-year products. There's even 40-year amortization products now, which is interesting.
The first property that I bought my parents' house with was a 40-year.
Yeah.
Yeah, I had
a 4.5.
I had a 40-year bank statement loan through
that's it. I did the same thing.
Deep Haven.
Yeah. Mm-hmm. Yeah. So it's a pretty decent product to help maximize cash flow in certain situations, right? The longer the amortization, the lower your payment's going to be. Mm-hmm. So our most product that was out the door most often provided to our customers is a 30-year fixed product, 30-year amortization with a 3-2-1 step down prepayment penalty. So
3-2-1 step down payment.
All business purpose loans, investor loans, will carry a prepayment penalty unless you want to buy it out. So prepayment penalty, there's typically two different ways about it. It's a flat, either call it a 5% flat, mm-hmm. which I will never put a borrower into 5% flat prepay. And if someone wants that, I'll show them what it looks like, but I'm going to highly advise against it. So 5% flat means typically for 5 years, if you want to pay off that loan, sell that property or refi it, within 5 years, you're paying a 5% penalty. Not doing that. So, like I said, most oftentimes we do the 3-2-1 step down, which is within the first 12 months, if you wanted to pay off that property, sell or refi it, there's a 3% penalty. Second year is 2%. Third year is 1%. And after the third year, after 36 months, there's no prepay. So you're in the clear.
Yeah. So, interesting. So let me ask you a question then. Mm-hmm. I actually have two of them here. A lot of folks out there that are trying to get into this probably don't understand any of this, and they'll basically listen to whoever's guiding them. Yeah. Is there something do you guys have to disclose that stuff at the time of lending, where look, if you pay it off in 3 years, if they don't understand something, is that something that gets disclosed at that process as you're going through the loan process? That's the first question. And two, if it doesn't, and let's say somebody out here wants to maybe have someone look at their current mortgage or whatever they have, their note on their property or anything that they have, is there someone they can call and go, hey, can you take a look and see if we can maybe do something better here with this? I'm not sure if I have the best one.
This guy. We'll take a look at our whole team. We've spent a lot of time training our team up to make sure that everyone's understanding of how to read those documents. Yeah. Your first question doesn't need to be disclosed. So inside of these business purpose loans, there's not a whole lot of disclosure requirements on the front end, right? It's all documented within the loan docs. Mm-hmm. But as you know, when you're at the closing table, it's too late a lot of times. You've already planned around this closing. Yeah. And when you're at that closing table to find out at that point that the prepay structure is, a 5% for 5 years, that doesn't work. I've seen some term sheets in the past 2 weeks, right? Because right now is an interesting time in the interest rate market. And to get back to your original question, interest rates are determined based off of risk in a loan, right? So higher LTV typically is going to come with a higher rate, right? Higher FICO score, lower rate. Higher DSCR will come with a lower rate. So the positives that you have as a borrower and for that transaction will lead to a lower rate, right? The more risk or perceived risk within that file, the higher the rate's going to be. Okay. But I've seen some term sheets over the past couple weeks, and in this market right now, as the interest rates are sliding down and there's, expected additional cuts, you're seeing people that are trying to price loans with prepay structures or certain loan features that are really negative for a borrower, really positive for the lender. Mm-hmm. Because a 5% prepay, if I were to do those loans, I would get paid a whole lot more, right, on the back end. Yeah. Right. What I would be, selling that and making, a 102, which is 2 points on the back end, we may sell it at a 104. So I won't do that to a borrower, though. I don't think it's wise right now in this environment to make sure that you're locked up inside of these interest rates, because I hope they go lower. I don't have a crystal ball, but I hope they do. But we've seen term sheets that are, 5% prepays or 5, 4, 3, 2, 1s. when you're looking at these term sheets on the front end from lenders, send them over to Consistent Capital. We'd love to take a look and advise, even if you have no intention of working with us. Like we want to be here to help educate and provide some transparency into this process, because there are not disclosure requirements on the business purpose side. You need someone on the front end advocating for you and making sure that you're getting into a good loan program. Because I got one 2 days ago that had 3 points to buy down the rate. And they showed me, like, I have this really sexy rate offer. It's like, okay, a 6.05%. It's a great rate, right? Right now, especially. Yeah. But they didn't realize that they were paying 3 points to buy down that rate, plus the 2 points of origination, and it had a 5, 4, 3, 2, 1 step down. So, like, the borrower had no idea that any of those were loan features in there. It's on the second page, like kind of at the bottom, identifying those loan characteristics. So, really drill in on those term sheets from your lenders and make sure that you're not getting caught into a loan that has these features that will negatively affect your ability to do other things with that property going forward, whether it's sell it or refi when rates drop, where you can get some additional cash out and money off the table.
Now, are these like rate buy downs and all these like term sheets we're talking about, are these only for like business products, not the personal products that you're talking about? Like, not the FHA buyer, the first time home buyer. It's only for people that are like using these properties as rentals? No,
like a conventional loan, like qualified mortgage world requires disclosures. So they require, typically within 3 days of application, that they disclose everything, right? Within a huge, package, and giving advice. There's FHA home buyer guides that have to be distributed on the conventional side. That's just not the case inside of the business purpose, because we're ultimately lending to businesses, to individuals who, should have experience and understanding of how to navigate this world. But that's not always the case, right? I love working with first-time investors. I think it's great. We get to build a business together, right? Helping them get their feet wet in the industry is like a passion of mine. That's why right after this, we're doing our lunch and learn. And I think we've got like 20 first-time investors that are interested in learning about what a DSCR loan and what a fix and flip loan is. So we love that side of the business, but it comes down to knowledge and understanding of these loan products. And we're happy as a group to help assess these and make sure you're going in the right direction.
Yeah, we're going to make sure that we put this info in the show notes for you so people can reach out to you. Because I'm sure, we get a lot of questions from people asking, like, hey, I don't understand loaning and things like that. I mean, me specifically, like, I'm super intrigued with this conversation because there's a lot of stuff that you're teaching me now as it is. So in terms of, like, when somebody submits documents to you and they're first-time investors, right? I like the fact that you say you like to work with first-time investors. Because there's a lot of people out there that are still trying to be like, hey, there's this like, in the lending world, you have to have 20 deals under your belt in order to go get a loan. What is it?
Experience.
Correct, experience.
Yeah.
And so it's like you're saying you want to work with people that are first time getting into it, so they don't have that
big track record.
Yeah. I don't want to. I'd like to have the experienced guys too, right? A whole lot easier to work with because it's just it's rinse and repeat. But you got to start somewhere, and I understand that. Like I had to start somewhere as well, right? And getting my first deals, like. I wish that I had a group like Consistent Capital, right, when I was first getting going, to instruct me about all the different types of loan programs out there. Because I started buying before I was really in the lending world. It's complicated, right? It's not something that you're going to understand all of the different things within a term sheet right away. And I think there's a lot of people that are intimidated to ask questions, right? Because they see the financing side of this as complicated and scary. It's not as bad once you have someone spend the time to walk you through all those different items.
I didn't expect us to go into really
it's been good.
I know we're getting to the top of the hour here, so any final thoughts? Any last minute questions you got here?
Yeah, we were wanting to kind of touch base for a few minutes anyway about this beautiful place you guys here have called the Helm.
Yeah.
And I remember walking it with your partner Dan when y'all just got it, and they were still working on the stuff up front.
Yeah.
And, he's like, hey, here's what we're renting these places for. And I committed to renting one. And then, a couple months later, we ended up moving. But, but it's just amazing to see y'all's vision kind of come, to fruition. And was just kind of curious to hear the story behind it and how this deal kind of came about and all the other progression that you can see down the rest of the road here, and everything just kind of continues to build up around you guys. And, so one, how did this deal come about? And two, how do you kind of see the use of the space within y'all's community here?
So when I was living in California, I had started buying some rentals and doing some projects here, and Dan was supporting me with those. He was helping me find them, right? if you're investing out of state, you need to have a rock solid team of boots on the ground. And Dan was that for me. So started having conversations, and I told him, I was like, hey, I'm not promising anything, but I would be maybe interested in making the move to South Carolina, Charleston. And we were in a tiny house in California, had our first kid, 2 dogs. We're like, this is just not scalable at all. And I don't want to have to go buy a $5 million house to get into a place where we can grow into as a family. So Dan found us a house in like 15 minutes. It was crazy. I couldn't believe it. Checked all of our boxes and flew over here the next day, put it under contract. We went golfing the next day out of Kiowa, and we were just chatting. Just wouldn't it be cool to bring, because I didn't know much about the investor community here at the time, but he was telling me all about it. I was like, well, why? Let's get everyone together in a place. And before that, I was never a big, subscriber to the masterminds and kind of these big coaching type events, but a huge proponent of them now. And I think the whole idea was let's replicate that type of environment that you have when you get a bunch of smart, cool people in a room together, where a lot of ideas happen. You generate $1 million ideas, right, inside of a conversation. So we had that conversation. We're let's find a big ass warehouse, do a big, let's have a golf simulator, let's have a co-working space, and then let's have a whole side of it that's for storage, for flippers, where they can store their appliances and materials. Not all of that worked out, but Dan called me 6 months later, and I had not met Dusty at the time, our other partner in the deal, and said, we found this property. It's pretty great. It's this small office building and this piece of shit warehouse on the backside. And this building that we're in right now it was a 2-year project. It was insanity. But the vision really morphed over time. It started with just half this building. Let's just make a little clubhouse with a little bar and maybe a golf simulator. And then Dan and Dusty called me we want to do the whole space. I was like, all right, we're sacrificing rental income, but sure, let's do it. Yeah. And here we are. We opened it up about a month ago and are opening up to members, right? So it's a co-working space, kind of like a WeWork, if you will, or any type of shared working space where people come in, use the daily desks, plug in for the day, surrounded by like-minded individuals. We got the nice amenities of the podcast and media room. We got a big conference room, golf simulator, full kitchen, couple bathrooms. It's a cool space. So the whole idea is just create an environment where you can create synergy with those around you. Yeah. And learn from one another. So
it is a fantastic place.
Yeah, I love it.
I
appreciate it.
We recorded 4 episodes here just in the last couple of days. And, great job.
Thank you.
Absolutely crushed it. Yeah, this is awesome.
Took some time.
The front side.
Yeah, you haven't, but so you've got your premier members, right? That pay rent up front for a true office space.
Yep.
And then you've got this space back here that people can kind of come and go for all those things that you talked about, right?
Exactly right. Yep.
That's a different membership price.
It is, yes. We've got the offices up front, right? So if you have an office up there, you get access to everything here. So 9 private offices up there, and it's all real estate professionals, which is cool. We've got Consistence in there, Consistent Capital. We got Rehab Walt in there. We got Dan in there, Dusty in there. We've got a capital raising group, a roofing group, 2 flippers, a wholesaler. So it's a cool group that's kind of formed in there. And then this is a membership basis, a small initiation fee, and monthly dues. Yeah. So the idea is that we want to make it accessible to people. We don't want to price this to the point where it doesn't make sense. And we want to get people involved because we know that, we'll make a little bit of dough from this place on the cash flow perspective. We're going to make way more money by the deals that you get into as a result of being a part of this community.
I love that.
Yeah.
People don't think about that. That's fantastic.
Yeah. And so we got a member app that you can book all the different amenities. You can see our whole event schedule, everything. You can RSVP directly through there, and then we're going to have a deal board built out as well. So cool. Share deals, invest in deals, share resources. Hey, I found this new cabinet guy who's killing everyone on price, and so that type of stuff is you want to share within this group.
Yeah,
very cool. I love that.
Yeah, and you don't have to necessarily wait for the monthly meetup to get that intel.
Yep, exactly right.
Dude. It's funny, we didn't even get to dive into your story and stuff like that. Maybe we'll have to have you come back on for a second.
Let's do it.
Yeah. This was really good.
Yeah.
So, being that this is the Big Break Show, we always ask at the end 3 questions. And the first one is do you have a defining moment that you would consider your big break? That something that you go, thanks to that specific thing, I am where I'm at today.
That big break was probably... so fortunate for my experience at my last company, but making the move here and realizing, stepping away from that business, the opportunity to create something for myself and my family, right? At the helm, right, if you will. And there was a really just big moment inside of there where it kind of a flash of a future vision of kind of what we could do inside of this investor community in the Southeast with developing of Consistent Capital. There was that flash, and the pieces didn't really start to fall into place until I had just an incredible conversation with Kelly Garrett. And you guys know Kelly, like she's a dynamo, man. I mean, she's the friggin' best. And it was part advice and part, recruiting at the same time, and a great conversation. We're like, let's link up. Let's make this happen. And so there was a kind of a flash at that moment of kind of what could come. And that partnership with Rehab Wallet's great. And our other partners that are passiveinvesting.com, that whole thing has come together just very, very well. So that was kind of that moment for me.
That's awesome.
Yeah. Next question is going to be, what is the best advice that you've ever received?
Best advice. I can't boil it down to like a saying or just a one sentence thing, sure. But my past CEO and mentor from Civic, Bill Tesser, I've never seen anyone that takes care of his people in the way that he has. And that's something that I think I've just tried to embody, right? Whether that be your coworkers, right? The people that are working underneath you, your service providers, your capital partnerships, your family, right? Just the way that you treat people just affects everything in your life. So I think the ability to just really take care of your people, think about them first and foremost, will lead to success.
I think that's fantastic.
Yeah.
That's awesome. 100%. So give the listeners and the viewers an actionable step. This is number 3 that they can take right now based off the conversation and go and apply it to their life, business, whatever it is.
I'd say I'm an expert in real estate financing, right? And I want to implore anyone that's watching this to really dig in on the financing side. It's where you can really make or break deals, right? And we are here as a resource to support any investor, new or super experienced in reviewing loan terms, whether they're from us or from someone else. Like truly, like we want to be an educator and help support people in the understanding of financing in this world. So give us a call at Consistent Capital. We'd love to help you out. And go on the website, consistentcapital.com, and you can actually apply for a loan right there. And we hope to hear from you and hopefully work with you.
Appreciate that, dude.
Yeah. How can folks look you up or follow you on social media? Or I know you just dropped the website. Where you do any social media at all? We do. We're starting to really ramp it up right now, which is good. And it's something that I have not been great at historically and focused on. But God, man, the power of it, right, is it's incredible. You guys know it better than anyone. Yeah. So consistent_capital is us on Instagram. Find us on LinkedIn at Consistent Capital. Website, consistentcapital.com. Yeah, any of those. And then we're going to be looking to develop some podcast stuff as well and keep contributing, hopefully with you guys and people in the network. Absolutely. Yeah.
Dude, thanks for being on.
Absolutely.
Fantastic conversation.
Cool. Appreciate you guys. Yeah.
Appreciate it, man.
See you on the next one.
See you guys.